Monday to discuss.
She put a
We're heading into election season with a large amount of attention focused on distress in the rural economy that has emerged over the last couple of years. Politicians are falling over themselves to find solutions to this distress, but they may do well to first try and understand some of the causes. An RBI committee on household finance headed by Tarun Ramadorai had some key insights into rural household finance and also broadly household finance in its report, which was released in 2017. Professor Ramadorai is here with us. We thought we'd seek some thoughts from him on some of these matters, which are very much within discussion right now. Professor Ramadorai, lovely to have you here.
Thank you very much. Nice to see you.
I'm starting with one aspect of your report, which I know was not the big theme of it, but you had some interesting insights into household finance in rural areas, what causes distress, the structure of household savings in rural areas as well. So my first question to you is, as you see this sort of news flow around your rural distress, what are your thoughts as to some of the sort of very obvious causes where it's emerging from?
Okay, so one or two things are probably worth saying at this point, some of which are outside of the areas of competence of the report per se. Clearly what's been happening over the last few quarters, and certainly over a longer period of time as well, is that rural incomes have been rising at a pace that's lower than inflation. Certainly in the last couple of quarters we've seen evidence that that's the case. And so we're seeing evidence that households are failing to be able to get exactly the kinds of incomes that they need in order to continue to do their day-to-day activities. Now, there's been a huge amount of activity on trying to address the household sort of symptoms of the problem. But there are some underlying economic factors as well that might be responsible for this. For example, it's unclear that we've invested as much as we ought to in things like clean land titling, in the fact that if in order to get a loan and in order to qualify for credit, you have to be able to establish title to a certain kind of a plot of land. We don't necessarily have those mechanisms in place. There are also obviously problems with the cold chain, with the introduction of new technologies into these areas. So all of these factors need to be viewed as a kind of background, which is some of the fundamental infrastructural reforms that need to be conducted in the economy. But on top of that, if you were to ask the question from a household perspective, what are the big issues that are facing rural households and households more generally? Well, first of all, they have a set of risks that they face continuously. The Rabi crop fails, the Kharif crop fails. We've had a disappointing Rabi crop in this particular harvest season. What do you do when you don't have insurance against the fact that the crops fail? And if that insurance is there, are you actually getting the claims for the premiums that you put in? So that's kind of one area. And then there are other areas, of course, which have to do with how do households cope with that distress. Suppose a health shock hits you at the same time that a crop shock hits you. How do you cope with the simultaneous materialization of simultaneous risks hitting you? But so many different issues, many aspects, but we can talk about any of these in detail.
So one of the things you pointed out in your report of again where the risks come from. So crop failures was one of them, and the other was crop income. Sort of decline in crop income. Right. My question there is that we went into a period in the economy where in a very sort of thought out manner we wanted to ensure that MSP rises were not as sharp as they had been in the past because we wanted to control inflation. Right. My question there is then should thinking have gone in the direction that if MSP rises are not going to be as sharp as earlier and nominal incomes are going to decline, then we need to plan ahead to ensure that farmers don't get into perhaps the situation they are in now?
Absolutely, but I sort of view both MSP and things like loan waivers as an ex-post solution to the problem, and you're completely correct, which is that if I think that these are solutions that get implemented after we see the materialization of distress, we ought to do something before we see the materialization of distress and do some planning ex ante. Now, how do you deal with that? So one is, if I had already put in place an insurance scheme which meant that people were not going to necessarily cope with, not necessarily be subject to the same types of risks, then perhaps we would have had a better situation. The other problem, of course, is that MSPs are targeting something like 30 to 50% of the farming population. There's some research that's coming out that tells us that farmers don't even, in some cases, know of the existence of the MSP or know about the size of the MSP in the case that they know about the existence. And are they able to access that MSP in the presence of leakage, in the presence of inefficiencies in the system? Also unclear. So one might question the entire MSP system in the first place. But you're right that, say we are to live in the world that we are to live in, we have the MSPs and we have a policy that we're not going to sharply hike MSPs in quite the same way as we are going to. If that's the case, you're absolutely right. The other question is, how do I manage the transition to a system where I have lower volatility in MSPs and a sort of fairly steady growth rate in those things? And of course, we then have to get into this issue of, can I afford to raise MSPs when I'm already sitting on huge stocks from the government perspective? And if that isn't the case, then why am I not planning? I mean, in a sense, what we're seeing is this painful situation where we're constantly applying band-aids to what is a structural wound. And now the question is, how do we get out of that system? How do we get out of that trap?
Yeah. So some amount of pre-planning, and now I guess, well, the situation isn't looking that great. So some amount of band-aid may be required to then move to, sort of a slightly more structural solution to agriculture.
Right. I mean, I would agree with that. But then I think the problem is that we are always applying the band-aids, but we don't apply the structural solutions simultaneously. In a sense, what we'd love to see is a situation where you say, I'm going to do now, of course, the other question is, how do you do the band-aid? So there are 2 or 3 different ways you can do it. You can do one through loan waivers. There are problems, of course. On the one hand, it does alleviate farmer distress, which is a very serious problem. On the other hand, there are these issues of moral hazard that it raises. Yeah. No question about that. As an economist, you understand that there's a benefit and a cost to a loan waiver. Yeah. If I do an MSP rise, what does it do? Does it get to the targeted beneficiaries in the presence of leakage in the MSP system? We're not sure about that. And then, of course, you've got this Raitu Bandhu type scheme that you can do. And in a sense, the targeted income transfer scheme, as long as you can do it in a way that's effective, as long as you can do it in a way that doesn't get sort of people having to show you about the plot of land that they've got, and then you get into the Patwari system, which then sort of, again, leakages and inefficiencies in that system. Can we do that? It's been electorally successful. It's been something that has helped people. But then here's the other problem. As soon as you put in a scheme in place, the electorate always has loss aversion, which is, suppose I say to you, I'm going to give you a subsidy. People are very happy. But then subsequently you say, it's temporary, I have to take away the subsidy. People are very unhappy. So then what you've done is not just create a band-aid, you've created a permanent band-aid. Yep. So now the question is, how do you get out of this system where you constantly keep applying band-aids, and then you have to apply 2, and then 3, and then 4 in every successive period, and we need to get out of that.
Okay. I'll get your views on some of these schemes that have come out, but on loan waivers in particular. So I think your report had put down some numbers as to the informal debt coming in from the informal sector. So to the extent that they are helpful, I mean, everybody recognizes that they'll be helpful in a very sort of well, not marginal, but to some extent at best, right? Right. That recognition is sort of there now, because now at least at the center level you haven't seen a loan waiver. They've moved in another direction.
That's right. So I mean, I think people are understanding the consequences of loan waivers. But I think the other question, of course, is it's not just the fact that there are consequences of loan waivers in terms of moral hazard. If something like 40% of the debt is informal debt, and 60% of the debt is formal debt, and the 40% is happening for the weakest income segment of the population, it's obvious that if you don't have a good credit history, you're going to go to the informal sector rather than the formal sector. Then when you are actually doing a loan waiver, who are you targeting? Are you really targeting the intended beneficiaries in exactly the same way as I would argue the MSP system works? Which is, in many of the cases, the band-aids are not reaching the people who need them the most. So I think there's been a recognition of that. I think it's less driven by considerations of moral hazard, because I think ex ante, of course, you don't want to commit to a policy of waiving loans. Ex post, when there is actual distress, it's a time inconsistent problem. You have to wait. I mean, you have to do something in order to alleviate or staunch the bleeding that's happening at that point in time. Now, you're right that we've moved away in some sense from this policy of loan waivers. But now the question is, how do you take that area of informal credit and move it into the formal system? Is there a way for us to start bringing informal lending into a more formal environment? The solution has historically been, let's ban informal lending. But they are addressing a felt need in exactly the same way as many of these other schemes are, loan waivers, MSPs, etc., etc. Is there a way that we can try to bring the informal lenders into the tent? That's another question we need to ask. They have better distribution networks, they have better information on the ground, they understand people. There are historical networks that they have built up. So if you go to small villages in Tamil Nadu, for example, where I originally am from, everybody understands precisely where the people are who can give you the cash that's needed in order to finance your everyday transaction. That's an historic relationship. They know each other. There's a strong relationship of trust in that environment. Yes, of course, the interest rates are very high. Yeah. That also, in some sense, reflects the marginal benefit of the credit to the beneficiaries. Is there a way we can try to do something about that?
It's interesting you bring that up. I think long back the RBI had made an attempt, I think it was under Dr. Y.V. Reddy, to bring money lenders into the formal fold. It didn't go anywhere. Yeah. But you think that's a conversation we need to start having again, maybe?
I think it's really important to do that. I think we have this sort of feeling increasingly that let's sort of out with the old, in with the new. You know, let's just kind of abandon all of these informal systems. But in a sense, these networks have been built up over generations. We're not going to be able to replace them overnight. I don't care how fantastically successful your technology is. It's not as though Facebook is going to come in here and start doing this. I was going to ask you whether
digital lending is going to fill that gap, but clearly not.
You know, I think these things act as complements rather than substitutes to the system that we have. And so in a sense, you've got to try and overlay technology on top of a pre-existing social network structure. Because, I mean, these people are going to trust other people, certainly if they're at low levels of financial education, financial sophistication. And so in some sense, you need to build on that personal network structure that we already have. And I do agree. I think we have to restart that conversation, and I think it's a good time to start to do that.
A couple of other questions on rural household finance, and then I'll move on. One is that, again, in your report, you talked about the importance of insurance. You know, we've seen this government do both crop insurance and health insurance, move towards that. Any initial thoughts on the design of those schemes, whether they can prove to be effective?
So one of the things in my committee's report, we talked a lot about this, is on the one hand, putting in place an insurance scheme is obviously a good thing because it reduces the likelihood that ex post facto you will borrow and then get yourself into a debt trap because of the fact that you got into an emergency credit need situation in the first place. But the problem in many of these cases is how do I administer claims at the point at which I actually require the money to be transferred to me? Now, the problem with crop insurance schemes as we see them today is that the current verification procedure is that you come, then you have some representative from the bank, and then supposedly you have an independent third party who comes from the local sector. And then the three of you jointly decide on the veracity of the claim that you put in. Now, this is an inefficient system. It requires personal intervention. It requires people to take out of their time to sort of go out there and do this. Half the time it's not going to happen. I can tell you that once a claim has been recorded, within 15 days someone will have to come. But if you're in some far-flung rural area, the likelihood of that happening is very small. The likelihood of people complaining about the fact that the claim has not been assessed properly is extremely high. This is the situation where technology can be our friend. I think we're piloting schemes in places like Jharkhand and other places like that, where we're using satellite imaging. We're trying to look at water levels using satellite imaging to try and look at whether the water level is up to the mark at which you might say a flood, you might declare a flood. So you can do things like you can use geosensing technology, you can put in sensors in strategically positioned environments, and then you can automatically have claims triggered. Okay. So one of the things that we have in our report is that we suggest catastrophe insurance being mandatory with some provision for automatic payments in the event of a declared event of some sort. And I think the more we can do things like that, the more effective these crop insurance schemes will actually be. Okay. Because of course the other big problem with these crop insurance schemes is if you have one person who has a poor experience of a claim, the multiplier effect of that is enormous. The likelihood that anybody else will want to participate in that claim, in that particular scheme, if one person in the neighborhood says, you know, I went over there and I tried to file a claim and kuch hua nahi and it didn't really work, likelihood of 10 guys not signing up for the scheme then increases very dramatically. And I worry that claims has got to be the #1 area where we need to do work in order to increase take-up and trust in these schemes in the first place.
Similar sort of set of issues for health insurance as well?
Health insurance is an enormous problem. I mean, this is a problem that is not just an Indian problem. We've struggled with this worldwide. I mean, I think, you know, the NHS is coming under significant funding pressure in the United Kingdom, despite it being such a incredibly valuable social institution for the country. One that was, if you remember, during the Olympics, there was a whole section devoted to this during the opening ceremony. In the US, health insurance schemes are coming under sustained problems. There's obviously been the big debates about Obamacare over there. So I think this is a broader problem.
Okay.
Now, a couple of points arise here. It is true that you want to target benefits to the 40% of households who are the poorest, and that seems to be the current
Yes.
point. But there are, of course, other questions that you want to ask. Is it sufficient to do inpatient care as opposed to outpatient care and inpatient care? We don't know. What is the incidence of diabetes and heart disease in this country? It's enormous. So then the question is, what about these lifestyle diseases? Are they covered or are they not covered? We've got about 15 to 16,000 empaneled hospitals. That's a great thing. It's a great start. Some of them are private hospitals. But again, do we really think that this is sufficient to cover the vast majority of the people who are coming in? I'm not sure. So, can we also strengthen the universal healthcare provision we have in the public hospitals as a front line for anybody who wants to come simultaneously with running the health insurance scheme? It seems to me that in an economy like our own, we need to devote substantially higher fractions of our budget to healthcare across the board. Health insurance is really important, but it seems to me that it's just one piece of a very, very large puzzle.
Sure. Just the last question on this aspect is, a bunch of different kinds of structures are coming out in addressing rural distress, whether it is land-linked transfers like the Raitu Bandhu or Bhayantar, which is, again, difference between the prevailing price and some sort of an average price, or then a, minimum income guarantee kind of scheme. Right. Do you have any thoughts on which is a preferable direction to start thinking in for the country?
So, I mean, I think one of the things that we know about is that targeted transfers where people receive actual amounts of cash in hand are the ones that actually work in some sense the best. I mean, standard economic theory would tell you that if I give someone cash, they choose the thing that's of the highest marginal value for them, rather than giving them something that's sort of, Now, of course, the other thing is that there's, in an environment in which capacity is limited to administer schemes, the simplest possible scheme is very likely to be the best one. I mean, how do we just get this out there in the quickest, most efficient, leakage-free way possible? Well, it has to be that you design the system in such a way that there's very little margin for error, there's no margin for fudging statistics, there's no margin for indexation issues. And of course, the other problem is the more complex the scheme. Suppose I mean, the difficulties of explaining to someone that I can't give you money because this index was not as high as that index, immediately reduces trust. In an environment where people are already thinking कि मुझे ये सब पैसा मिलेगा ही नहीं, to sort of introduce an additional step of explanation is always going to be harder. It seems to me that let's go simple.
Cash transfers.
Cash transfers.
Let them be put to use as they see fit.
As they see fit, yeah.
All right, and now we have the jam trinity, so there is some sort of a backbone through which some of these transfers can work.
Absolutely. There's a really, I mean, we have a better infrastructure to be able to deploy some of these things than almost any other country in the world now, and we should put that to good effect, it seems to me. I agree.
Sure. Let me move to urban household finance, some aspects of it at least. So we were eager for more financialization of savings. It has happened to an extent in the last 3 years. Your thoughts on whether it's going in the direction that you would have expected to, and some of the issues that are cropping up there?
Absolutely. I mean, I think what's wonderful to see is that there is, our report talked a lot about this, that we were unproductively locking up assets in both real estate and gold, and we need to see increased financialization of household balance sheets. And that's been wonderful to watch. Now, of course, there's been this, so I mean, one sounds a little mean-spirited to say this, but because you wanted this, but the pace at which it's happening is also a little frightening in some sense, okay? So the question is, when people sort of start deploying assets into the financial system, there are at least two problems that you can see. On the one hand, economists will tell you that if there's a positive risk premium in any asset, you should always invest some amount in that asset. And so it's good to see that people are doing that. On the other hand, much research has demonstrated that the way in which you participate also has a big impact on the benefits that you can realize from that participation. Sure. So to give you a very simple example, suppose I were to enter the stock market and then basically pick my 3 favorite stocks and then churn that portfolio every month, then that wouldn't be very good, because I'd be ending up paying so much in transactions costs that at the end of the time, I might as well have not participated in the first place. So the thing that worries me when I see rampant, rapid participation in the financial market is, are people really aware of exactly what they're doing when they're entering the stock market? Do they understand which mutual funds to invest in and which not to invest in? Do they understand that past performance, as we constantly say, is not a guide to future performance? Do they understand that just chasing after past returns is not necessarily the right thing to do? Does that then mean that when there's a small downturn in the returns that everybody suddenly starts walking things back and pulling money out of the stock market? So we don't know the answers to these questions. So in a sense, while it's wonderful to see the transition, one might have wished to have seen a transition that's a little less rapid than the one that we're seeing today. And of course the other thing, so we have some research. We looked at a decade's worth of actual microdata on 20 to 30 million accounts in India using the depository data.
Okay.
So we have
these are demat accounts.
Absolutely. Okay. So we have sort of, this is over an earlier decade. But over that time, we have a paper now in American Economic Review Insights, which basically talks about this, and I've written about this a little bit, which is that when you look at the smallest accounts that existed about a decade during the start of the data set, around 2002, those small accounts barely grow. In fact, they sort of slightly shrink 10 years later. And if I look at the biggest accounts, they grow by something like a factor of 10 over the 10 years. So then when you sort of unpack this, which is a fairly puzzling point, so why is it that the large accounts are growing faster than the smaller accounts? Turns out that the smaller accounts are earning an average rate of return that's higher than the larger accounts. And then you go, well, this just exacerbates the puzzle. And then it turns out that it's the volatility of those portfolios that's at issue. Put differently, the larger accounts are diversifying much more efficiently, and so their risk-return trade-off is far more efficient over the long run. Put differently, if you enter the market and you churn your portfolio and you're under-diversified, then the likelihood of you losing your little all is very high. Whereas if you come in and you do the sensible thing and you invest in a low-cost index fund, spread your money out amongst multiple bets and do a fairly conservative buy and hold strategy, you end up doing pretty well. So now the question is, are the people who are participating, are they aware that this is what they need to do? Is there a low-cost index fund market that we've developed yet? Not really. Are they paying very high fees? They probably are. So what are we supposed to do about all of that?
You waded into the mutual fund debate, which is very active. I think we've all been puzzled about sort of this proliferation of credit opportunity funds as just one segment, which at some point was starting to get compared to fixed deposits, and boom, you get hit by corporate credit defaults, and you realize that these are not exactly capital returning products, right?
Yeah, but in a sense, I mean, it's what I'm trying to say is that whether or not things are happening on the supply side, the real question is, are the people on the demand side really understanding what they're doing? It's perfectly fine to take risk and get rewarded for those risks. The big question here is, are the people who are entering the market now understanding the risk-return trade-off that they're getting into? That's all.
The answer to that is just education, right? I mean, what else could it be?
So unfortunately, financial education, while it seems like it might be a great solution, in many cases has not turned out to be such a great solution, because it's very hard to educate people even on the basic stuff like, should you diversify, shouldn't you diversify? What's the difference between real and nominal? Do you understand the difference between simple interest and compound interest? People routinely fail in their answers to these questions. They fail more if they're older, if they're less, they have lower income, and so on and so forth. This is from household finance research, we kind of know this. So then the question is, what's the solution? And it seems to me that maybe one of the things that we have here is a role where we default people. So in my report, one of the things that we say is, equip people with a minimum kit that you need to get into a financial market, a low-cost index fund or a target date fund, a couple of basic products, unsecured credit at low rates, secured credit at good rates, so on and so forth, mortgage markets that work well. Put differently, when you play cricket and you're facing fast bowling, what you don't do is you walk in there wearing a t-shirt and shorts. You wear pads, you wear gloves, you've got a helmet, you've got protective equipment that enables you to participate in the sport in the way you ought to. Seems to me that we should be equipping people in exactly the same way, rather than saying, I'm going to educate you that if you don't wear a helmet, you're going to get hit on the head. I'm going to say, here's your helmet. If you want to take it off, it's up to you. But if you are going to get into this market, you have to wear a helmet, some pads and some gloves, and then and only then can you.
And also sort of our tailoring of some of these products. I think that's another thing that you mentioned in the report, that you need simpler financial products which are easily sort of understandable by households, and that over a period of time increases the trust in the financial sort of sector as well.
Absolutely, and I think we'll reap very rich dividends by doing that. And I think we ought to do that kind of thing. Just keep things simple, keep things really well designed. That's robust. I mean, what we don't need is to bring enormous sophistication to the table. We don't need something that's fairly convoluted. We need something that's simple and, you know, and maybe customizable to a certain extent, but nothing too complicated. I agree.
Just last couple of questions. I did want to get a sense from you on, again, I'm sorry, I'm going back to the rural area too. Actually, not really. Financial inclusion, the efforts that we have made as an economy on financial inclusion, do you see them sort of paying dividends on two parts? One is access to, say, bank accounts through Jan Dhan, but also, you know, we've seen a lot more focus on more cost-effective lending to SMEs, etc., newer platforms. Is that sort of making dents slowly along the way?
So this is a great question. I mean, look, I think the focus on financial inclusion has been great. I mean, I think the fact that we've had almost universal access to financial services, certainly in terms of a bank account and basic access to those things, has been terrific. I think we're well on track to try to achieve that across the emerging economies by, you know, in the next couple of years, 2020, 2022, we're going to start to see those things. But in some of my own work on emerging economies more broadly, and not just India, what we're showing is that once you take the focus away from just including people in the financial market, you understand that just including them, you then sort of have a long way to go. By way of analogy, in exactly the same way that you might say to people you need to financially save, but then if you were to leave them to their own devices, they might make a set of decisions that might have made it better off for them to not participate in the first place. I think we're in danger of doing the same thing here. Put differently, I include you in the financial market, you now have a certain amount of money to spend, and the supply side comes looking for you as a customer. You don't necessarily know what you're doing, you're in a new environment. Should we just leave you alone? Probably not. I think we need to hold your hand and take you through the point, up to a point at which we're fairly comfortable that we can take the training wheels off and then let you go and sort of, you know, ride your bike on your own, really. And so I think life after financial inclusion, work on household finance and not just financial inclusion, all of these things remain super important. And I think we're at risk of saying, oh, we financially included so many people, you know, job done.
Job done. All right, fair enough. Last question, Professor Ramadorai. You're here in Bombay to address CAFRAL. Give us an insight into what you're speaking on.
Thank you. So, so I'm going to talk more about precisely this, which is household finance in emerging economies. Looking at the micro-survey data that we have from what is about 48% of the world's population, which is looking at official surveys from South Africa, the Philippines, Thailand, India, Bangladesh, and I'm forgetting one of China, absolutely. So we've got these 6 household surveys, and we've done some basic research on them, and we show basically that there's a huge need for household finance to be improved in all of these economies. There are features that they share that are very similar to the features that we detected in our Indian household finance report, the policy report that was done for the RBI. And to be precise, if I look at the wealth distribution in the emerging economies, if I look at sort of people up to the 80th percentile of the wealth distribution in their own economies, even on a PPP adjusted basis, they only approach about the 40th percentile of the wealth distribution in the advanced economies. Put differently, a person who is better off than 8/10 of the population in emerging economies is only as good as the person who is 4/10 of the way up the wealth distribution in advanced economies. But then what's really puzzling is when I move from the 80th percentile to the 100th percentile, there's a very steep slope, and the very rich in the emerging economies look very similar to the very rich in the advanced economies. So now there's a question here, which is if the rich are sort of fairly similar across country, and the poor are, you know, sort of fairly similar, where's the gap? And it's obviously the fact that we need to grow the wealth of the middle classes. It must be the case that we need more work on household finance. And once we do a little bit more work and dig deeper into household balance sheets in all of these countries, we see that the same problems that we've seen in other economies exist. Very low secured credit penetration, fairly high unsecured credit penetration, much of it from informal sources. A huge reliance on tangible assets such as real estate and gold, and not enough on financial assets such as savings in liquid vehicles of the type that we've seen, under insurance. You know, so basic problems of this nature. So I think a concerted push that can be made at the sort of emerging economy level would be a terrific thing to do, and I think India can really lead the charge on this globally, you know. So I feel like there's a big opportunity for us to take here.
All right, Professor Ramadorai, it's been lovely speaking to you. Thanks so much for
Pleasure.
stopping by.
Thank you so much. Thanks a lot.